Good afternoon again, everyone who's watching us on YouTube. This is Avon Pension Fund Investment Panel. We've just been discussing item 8 on the agenda, which is our infrastructure portfolios, where we had presentations from officers and advisors. So now we're back in public session. Can I ask for a mover for the recommendation 2.1 as printed in agenda item 8? I believe Pauline Gordon, you will propose that?
Opposed?
And
I'll second it.
Thank you very much, Councillor Crossley. I will assume that everyone is in favour, and if you're not, please can you indicate in the chat? So I'll assume it's passed otherwise. No, I'm not seeing anything in the chat, so that is unanimous. So now we go on to agenda item 9, which is our performance monitoring report. And I believe Nathan Rowlingson will introduce this item.
Thank you, Chair. So just briefly then on performance first, the fund return just under 3% over the quarter. Sustainable equities did very well despite the surge in gas prices. The other equity portfolios underperformed marginally due to this sort of structural bias to growth and quality stocks that we've discussed before. So the underperformance is very well understood in those portfolios, and there are no major concerns to raise at this stage. On RI, most of the coverage, as you'd expect, has been around COP. From an investor perspective, it was clear that the sort of onus to drive change falls on the private sector, and we've seen some sort of significant commitments of private capital to support the net zero transition. And from a policy perspective, it was interesting to note, particularly from the UK government, that climate disclosures are increasingly becoming mandatory and more stringent in what they ask for. And on that, we're actually going to be bringing our draft TCFD report as well as our RI annual report to full committee next month. And then at Appendix 5, you'll find a paper from Mercer on the current inflation outlook. And this is linked to the work being done by FRMG on inflation hedging. So it's, again, a paper for discussion only at this stage. And with that, I'll pass over to Mercer to take you through their various papers. Thank you.
Thank you very much, Nathan. Steve, is this you?
Josh is going to do the performance report.
Okay, sorry.
Yeah, so there was a later version of our report issued slightly after the main pack due to unavailability of some of the underlying assumptions for the value at risk analysis. So I'll just share my screen with that with you now. Everybody have that? Okay. Yeah, so just picking out the key points in our report, the funding level's up very slightly over Q3 at 101%. The assets outperformed the liabilities. So despite the volatility and supply chain issues later in the quarter that Nathan's mentioned, growth assets still delivered positive returns on the whole. And the LDI portfolio also performed very strongly as inflation expectations increased, helping keep up with the growth in the liabilities over the quarter. The value at risk increased by 70 million to 1.2 billion over the quarter, mainly due to the value of the assets and the liabilities increasing. The split of the risks between the various components actually remained broadly the same, but applying those stresses to a larger asset and liability value gives you a larger value at risk just by how the modelling works. Although performance has been positive over 1 and 3 years, it is behind the total fund benchmark. So the equity protection in particular has just held returns back as equities have performed very strongly. But this is in line with expectations. This is what we'd expect to see from those positions, giving you the protection if equities fall, but you're giving up some upside if equities rise particularly strongly. In terms of the rest of the report, I was just going to touch on some key highlights. So slide 9 shows our views on markets on a medium-term basis. So our medium-term view is that growth will remain strong, albeit with some potential short-term challenges. So corporate profit growth is expected to remain strong, but prospect of central bank tightening could undermine equity performance. And actually, as a result, we've reduced our conviction in equities slightly. As you can see in our dials there, we've reduced the position from a slight overweight to the upper side of neutral, just reflecting that view. Slight reduction in conviction there. That said, we wouldn't recommend any changes to the fund's investment strategy off the back of that. The rest of the report kind of obviously goes into that in a lot more detail. This is the value at risk that I've mentioned that wasn't in the main pack, but is in the later appendix that was issued, and just showing there, you see that the split of risks remaining broadly unchanged. The other point that I wanted to just bring out was the performance of each asset class versus the expected strategic returns. So most of the asset classes have delivered since 31st of March 2019, delivered stronger performance than the expected returns in your strategy. So developed markets in particular, on the equity side, significantly ahead. The underlying market has done well, and the active managers have done well relative to their benchmarks. Emerging markets on the right-hand side as well, also ahead of the strategic expected return, even though Q3 was a difficult one. And there was the mandate now being terminated with Brunel, and the proceeds moved to the other Brunel global equity portfolios. There's some gain relative to the strategic expected return being locked in. The next slide, so the diversified returns, the DGF with Brunel just ahead of the strategic target, and then a bit of a mix across the property mandates. So Brunel is ahead to date. It's an annualized return there of around 16% since 31st of March. But clearly it's a relatively shorter time period for that portfolio. So it's not been in place for as long as the rest. Schroders portfolio has been transferred to Brunel, and then the partner's overseas property still being drawn down. So although it's behind, it's a bit early to draw conclusions. Secured income, again, slightly behind since 2019, but has had a good year. So actually ahead of the strategic expectation over the 1 year period. In IFM, we've discussed performance in the exempt section, clearly very strong performance ahead of the strategic expected return, and over the long term meeting their performance targets. And finally, the Brunel renewal infrastructure portfolio, again, still drawing down, so a bit early to draw any meaningful conclusions on performance there, but we'll clearly get a better picture of that as time goes on. That was everything I was going to pull out of the report, unless there's any questions on that.
Could I just ask a question about the value at risk? Does that take account of the risk strategies that we've put in place?
Yes, it does. So there's a reduction in particular on the assumed volatility for the equities. It allows for the fact that you've got that ongoing dynamic protection in place. So previously that equity component was a lot higher. I think we discussed that in a meeting about 6 months ago, and we showed the sort of difference that made the overall risk.
Okay.
The risk.
Yeah, I was slightly sceptical when I saw that because it came down such a lot. I think maybe it was about a year ago. So could that be right? Maybe slightly less, but you persuaded me that it was right, because I think we went down from about 1.5 to about 1.1.
Yeah,
from memory, something of that magnitude, Shirley.
Yeah, I think it might be helpful to remind ourselves of that, because when I look at this, I'm thinking, is there something else we should be doing to try and reduce these scenarios? And of course, we already are doing something. So I wonder whether that for future reports we can maybe have a comparison with the VAR without the risk strategies, if that's easy to do.
Yeah, we could do that, Shirley. Yeah.
Thank you.
Yeah, so we've definitely got more control over the VAR than what we had. And Pauline, your magnitude of figures that you quoted was exactly right between the start of the year and March. But the kind of phenomenon that we're seeing is that as the value of the assets is just getting larger because of rises in asset values, that is actually sort of increasing the VAR again.
Mm.
Yeah, and we've actually got a metric earlier in the report that shows it as a percentage of the liabilities as well, and that's not increasing to the same extent.
Yeah.
21.4% of liabilities. And if you can see this chart here, it sort of remained broadly stable over the last year. Yeah, that's obviously quite a small scale on there.
Yeah.
I mean, in future, it might be possible to think about, controlling risk around that kind of percentage metric.
Mm.
And, we can compare it to sort of say other LGPS funds just from an anecdotal perspective.
Yeah. I think,
further thought.
sorry, with, because we're in a very good funding position, you always think, well, should we be doing more? Is there anything else we should be doing? And I'm not saying we should have that debate, but we should at least remind ourselves of things that we're already doing because of the strong funding position.
Liz, you had your hand up, and then Tony, or have you taken yours?
Sorry, mine was by accident.
Okay, Tony.
Yeah, thanks. I was just contemplating the fact that there's always going to be an element of risk in the portfolio. That's kind of the business we're in, really. So the value at risk is always going to have a minimum kind of threshold number. And I guess from the interesting bit from my point of view is how far away we are from that, really. So are we taking on? Are we now, because of the way the portfolio grows, and then the disparity we have in sort of our investment allocations, are we then seeing that reflected in taking on more risk than we would be normal if we simply stuck to our allocations, our percentage allocations, on a more rigid basis? Sorry, that was a question for Steve, really.
Yeah. Actually, given Shirley's question, I was actually sort of thinking it's worth just reiterating that we'd never just look at everything in a sort of pure investment context. We'd also look at the wider funding as well, and so there is some work being done on that with Paul, because there are obviously some issues to consider regarding to affordability with other employers. So. And we have done some kind of joint work looking at sort of funding outcomes and implications from an investment strategy perspective. So I think that would be a good issue to discuss perhaps more broadly in the future.
Okay.
Thank you, Josh. Do you want, or Steve, is there anything else you'd like to say at this stage?
No, there's nothing else I was going to add.
No.
If there are no further questions or comments, we will then go back into public session, and we'll be asked just to obviously note the report and we haven't really identified, just Liz, just to clarify, we haven't identified any issues that we need to notify to the main committee, pension fund committee, have we?
No, we haven't.
That's okay. Just so we can say that in the public session. Okay, thank you. So in that case, Mike, can you move us back in? And then I'll just say that we note that, and there was nothing that we want to identify, that we've identified that needs to be taken up to the main committee.
Chair, you're in public session.
I do apologise. I thought we'd gone into exempt. Sorry, I thought we'd gone into exempt. Do apologise. Right. Hello. So item 9. Can I have a mover for the recommendation, please, of 2.1, that we note the information in the report, and we have not identified any issues that need to go to the full Avon Pension Fund Committee.
Happy to propose that, Chair.
Thank you very much.
Chair, I didn't know whether we wanted to talk about the inflation paper in Appendix 5.
Sorry, that's why I'd got.
Yeah.
Yeah, I wondered that as well, but I thought we were possibly going to go back into exempt session, although we hadn't actually got into it in the first place.
Sorry, that's my poor chairing. Apologies. So that's that appendix done. So move on. Yes. So to our other appendices. So we want to go on to appendix item 5.
Item 5, yes.
Yes. Sorry. Back over to you, Steve.
Okay, so this is the inflation.
Friday afternoon.
Yeah, yeah. This is the inflation discussion paper. I'll just go through that. So I'll just put the slides on screen.
Please, can I check, Chair? You're still in public session. Is that correct?
This
yes,
is
for this one. Yes.
for this one.
Yes.
Okay.
Yes.
Okay.
Yes.
Okay. So hopefully you can all see the slides. By way of introduction, there's no recommendations. This is very discussion based. We could spend 5 hours talking about inflation, I think, and the reasons for it, how it's going to pan out in the future, and the impact on the fund. Obviously, we don't have that time, so we're going to try and take you through those are the key points of this kind of broad, wide-ranging review that we've done. It's obviously very topical to be talking about managing inflation risk, and to really sort of bring it down what that means for the fund. It's really about, is the level of return that we get on the assets, is it going to keep pace with inflation? Because all your liabilities that you should pay out are linked to inflation, and your discount rate has got a CPI inflation linkage to it. And to put it in perspective, if inflation rises over a given period by 1%, and the assets, the performance of the assets don't keep pace with that 1%, that's the equivalent in risk terms to a 30% drop in the value of the equities, and would put a kind of like £700 million funding strain. So I think it's useful to sort of put that into kind of context to help really sort of understand what the inflation risk means to you. You'll often hear.
Can I just ask you a question on that?
Yeah.
When you say if inflation raises by 1% and the assets don't keep pace, then this would be equivalent to 30%. That's if it's completely doesn't match the whole 1%. So if the assets kept pace by 0.5%, then does that mean the equivalent fall is 15%?
Broadly speaking, yeah.
Thank you.
Yeah. Now, so there'd be no issues about being able to pay pensions, because you've clearly got sort of £5.5 billion worth of assets, and that's not going to. They're going to be around for a long period of time. It's all about the impact on future funding. But it's really about you need your investment returns to keep pace with inflation. But we'll show later, depending on what type of environment that we are in, different asset classes are going to behave in different ways. So one of the key conclusions that we sort of come to is that there's no one universal perfect asset or perfect investment strategy that is going to potentially cover us for all types of inflationary scenarios. So one of the main takeaways that I took from the analysis is that it's really important to have lots of diversification in the portfolio, because different asset classes will help us in different ways at different times. And we do think you actually are overall pretty well positioned to sort of weather various scenarios, because of the different exposures and physical asset classes, and also the risk management strategies that you've got in place. There's potentially always the question about, can you do more? Can you get more inflation sensitivity, more inflation protection? And the answer to that is yes. And maybe we can come back to that later on. So just in terms of why we're talking about inflation now, I'm sure everyone's aware of this. The most high-profile issues are in relation to supply chain, increase in energy prices, friction due to Brexit, and it does feel to us as though those issues, and some of them are UK specific, such as the Brexit friction, but a lot of these issues are global in nature in terms of energy prices and supply chains. They do seem to maybe tipping the balance away what had been long-term deflationary pressures in the form of populations getting older, supply shortages, debt, and also technology. And technology and demographics, they've really been the key drivers to deflationary environments over the last 20 years or so. And the concern around inflation is, is it transitory? Is it structural? I.e., is it going to be more permanent? and then the potential for that just to sort of lead to sort of greater range of outcomes and greater uncertainty as to sort of what inflation could look like in the future. A bit more context. So Bank of England inflation target rate is 2% per annum. Currently quite ahead of that, as you can sort of see on the chart on the top right, and we're roughly sort of double that amount actually. CPIH inflation for October on an annualized basis is running at 3.8%. So almost double the target. And then you can see in terms of projections of future inflation, in terms of the market at least, expecting it to sort of potentially sort of come down. But who knows really? The markets tend to be sort of pretty poor predictors as to sort of what the outcomes will be in the future. But clearly we do have a heightened sort of elevated position of inflation, and there's just a lot of uncertainty as to sort of whether or not that is going to be sort of short term or sort of more medium and long term in nature. So a bit more context on the impact that this could potentially have on the funding position. So a rise of inflation of 1%, all else being equal, would increase the value placed on the liabilities by 20%, and it's about the relative impact that has in terms of the asset performance. So if we do see these prolonged increases in inflation, it's really important that the assets keep pace. Now, in terms of the discount rates for the fund, we've been kind of flagging probably for the last 6 months that the probability of achieving the past service discount rate of CPI plus 1.75 has been sort of coming down. And that's not because our forward-looking returns from an absolute perspective on the strategy have come down. It's just because CPI inflation expectations have been sort of creeping up. So it just means that it's going to be a little bit harder to achieve the returns that are being assumed in the overall funding plan. And then in terms of the size of that reduction in probability, it's come down based on our estimate from around about 63%, so almost kind of at 2/3, which is a very sort of typical measure that we would look at, down to sort of 57%. And then on the right hand side here, what we've got is just like a very stylized example to show you what the impact could be on the funding position if the assets out or underperformed inflation essentially and the discount rate. And you can see that we've assumed 3% outperformance for the pink line here, 3% underperformance for the blue line, but you can see that over relatively short periods of time, you could start to sort of see quite rapid declines in the funding position if the assets don't keep pace with whatever inflation is. So that's really just to sort of underline why this is a really important strategic consideration. And then one way of looking to assess the impact of the inflation risk, we put this qualitative framework thought piece to sort of think about it just at this stage, and that's around thinking about the likelihood of in different inflation scenarios. So we've got a slide on that. Then we can think about, okay, what would be the actual sort of portfolio impact, and then you effectively sort of multiply the two together, and that gives you, what the exposure is. So we haven't done that in detail for this session, but if you wanted to, it could be something that we could look at in more detail from a sort of quantitative perspective. But for the purposes of this discussion, we've kept it more at sort of the qualitative level. So looking at different future states for inflation, we've got some more charts on this, but in terms of what drives the inflation, we can generally sort of put it into sort of two high-level categories. they're kind of like demand pull drivers. So that's anything to do with economic growth, and then sort of monetary or fiscal policy. And it's monetary and fiscal policy that's really been dominating sort of the macro environment over the last few years, in particular since COVID, because we've had these massive central bank stimulus in the form of quantitative easing, money printing, perhaps artificially low interest rates, but also we've seen sort of a huge amount of government expenditure in the form of a lot of it is infrastructure based. So in the UK, you've got the whole levelling up agenda. You've also got support in terms of furlough, etc. But that's not just a UK issue. It's happening sort of globally, as John mentioned earlier. The US infrastructure bill. So this is very much as a global issue. And then in terms of the cost push drivers, we've got these sort of three factors. The first two I think are extremely topical at the moment in terms of increasing supply costs. Then there's anything to do with labour costs. Generally, they'd be sort of bringing upward pressure on inflation. And then we've got sort of technology product gains that they've generally considered to be sort of downward. But as I mentioned earlier, we think maybe sort of the balance of these drivers is potentially sort of changing.
Steve, I think Pauline's got a question.
Sorry, my question actually related to probably something right at the start really of this section, and I could have picked it up later, but anyway, I'll just bring it up now. So in the corporate world, you wouldn't really see a valuation basis CPI plus, but you may see something around real yields, which are sort of 10 to 20 years out on the curve. Now that obviously would mean that we're much less exposed to the current CPI rate in terms of the valuation basis. And I just wondered if there was any, because while I think, it's absolutely right that, we are exposed to inflation and we need to do something about it, I'm not so convinced that we need to be so worried about, the rate of CPI. And I just wondered if there was anything that we could talk to perhaps the actuary about in terms of the basis, because I've never really felt the CPI plus was a very sensible liability basis. And particularly, we're kind of feeling the impact of that now. So, we can talk about this at the end, but it's just something to kind of, I don't think we should be driven by a basis that perhaps we could move from, is where I feel I am.
Yeah, no, Pauline, so it's a fair question. It's always good to have that discussion about the basis, I think, and just be sort of aware of the consequences of it. So just a bit of background. Up until maybe 2 valuations ago, it was like very common for LGPS to have discount rates that were gilts based. So there was more commonality between the way the discount rate was derived then with LGPS and corporate schemes, private sector. Private sector obviously sort of went down the route of doing a lot of liability hedging. So getting very explicit mark-to-market protection against downward movements in interest rates and upward movements in inflation, and that gave you the real yield exposure. LGPS never really embraced that, because I think the LGPS as a community as a whole, I think struggled with the idea of just locking into gilt yields, even when they were say 4%. So as a result of that, there then became a shift to move away from gilt-based discount rates to something that was more LGPS specific. And this is where CPI plus discount rates came in. Another alternative to a CPI plus approach is where the discount rate is, say, broadly in line with the expected return on the assets. So if you've got an expected return of your portfolio of 5%, your discount rate could be sort of close to that. In practice, though, often with that approach, there is some form of connection to CPI going on in the background. So that's a sort of long-winded way of saying that I think LGPS and for Avon, we've already moved away from a gilt plus approach to a CPI approach. We think there's a greater level of, it's just more intuitive, given that the liabilities that you do pay out are very direct, they are directly linked to CPI. So it's probably one to have a broader discussion with the fund actuary, that's where we are, and I think so far, everyone, most people are, personally, Mercer remains comfortable with the use of CPI plus discount rates, but always good to discuss. So in terms of looking at the various scenarios of where we could go from here in terms of growth and inflation, we've put together as a framework here, and we've tried to express a probability of these scenarios kind of panning out, and there's 3 scenarios really that account for the bulk of the probability. So 70% here, which we've spent most of the time thinking about, but there are some sort of outliers which I'll sort of touch on. But in terms of the ones that was looking at most, we've got the balanced growth scenario. So that's where economic growth and inflation is moderate, it broadly pans out with forecasts, generally doesn't form a massive problem. Actually, that's actually a very positive environment for most asset classes, and for a portfolio that's broadly diversified across major growth asset classes, you'd expect to do sort of fairly well. So there's a 30% probability on that, but we could easily see scenarios where we slip into more damaging scenarios. And the first one to consider would be if there's a hard landing, and that would be as a result of quite a sharp slowdown in growth as a result of inflation concerns. And that would be triggered, in our view, if there was a sort of sharp rise in interest rates. And then that could very quickly sort of move into sort of a lower growth and in a deflationary environment. And then the other relatively high scenario that we've been looking at is one with we've referred to it as financial repression. And so the main feature of that scenario is where we've continued to sort of see very low interest rates, perhaps sort of artificially sort of lower than would otherwise be the case. And then there's some other scenarios such as the Goldilocks, the overheat, and perhaps the most damaging one is the pandemic stagflation one, which there are some sort of more descriptions about. But we'll show later on, I think it's in the next slide, about a qualitative overview of how we expect different asset classes to perform in different scenarios. But just to signpost it here, the scenarios that are most damaging, which would be overheat and pandemic, they're actually sort of scenarios that we really would expect the risk management strategies to kick in, especially in pandemic. That would be sort of very damaging for some growth assets in general, and the potential for that to have a knock-on impact on equities is not insignificant. And if we do get a sharp pullback in equities, that's where we'd expect the dynamic protection that we get from the equity protection strategy to kick in. Just before that, though, we did want to sort of recognise that we could have come up with a scenario where it's exclusively sort of focused on the energy transition, but actually we think the impact of the energy transition and the sheer amount of capital that needs to be spent on new forms of infrastructure will be sort of inflationary, but will happen regardless of other sort of macro variables. So we haven't looked at that in isolation, But if we did, actually, we do think that would be sort of quite inflationary over the long term. So this was probably the main slide that I wanted to sort of spend a few moments on. And what we've looked to do is, so on the left, we've listed the major asset classes that pension funds typically invest in. The ones in pink are the ones that the fund has got exposure to. And we've listed what the benchmark allocation is. And then for those kind of scenarios that we discussed, high level, we've graded it red, amber, green, about how we would expect those assets to perform in those type of environments. So just a bit of context, you've actually got a lot more direct inflation exposure than most other LTPS funds. And that's a result of the inflation hedging strategy that we've got in place. So where you've got 12% in index-linked gilts, that's actually providing a 40% inflation hedge in terms of the value of the assets. The other way that we get some form of inflation linkage is the exposure to real assets. So the real assets that you hold are the 17.5% in property and the 10% in infrastructure. And so when you add all that together, it's reasonable for us to sort of say that you've almost got like 70% of your assets with some form of indirect or direct linkage to how inflation will pan out. And I think the big difference there is most other LTPS funds only have the real asset exposure. And I think that's useful to consider, because for investors that are, very concerned about the impact of inflation within, say, the near term, call that next 6 to 12 months, to address that in your asset portfolio through investing more in real assets such as infrastructure, renewable energy, property, is pretty much impossible, because it takes so long to get invested in those asset classes. If as a group you feel as though you want to do something more in inflation, in terms of inflation protection, the route that we'd be suggesting is through the inflation hedge overlay that you've got in place, because you can make changes to that very quickly once agreed. So that speed of change, I think, is really important to consider in terms of the makeup of the investment strategy. And so in terms of comments on various sorts of asset classes, you can sort of see by the spread of colours that there is no one asset class that's going to sort of work out well in all types of environments. A couple of areas that I did want to highlight, though, was the introduction of the 5% allocation to private debt. That actually could become a really useful part of the portfolio going forward. So the reason for that is private debt is referred to as a floating rate asset. So in theory, the coupons, the returns that you get on private debt will increase as interest rates rise. And so interest rates could rise as a result of very prolonged and sort of high inflation. So if that happened, actually, we'd expect the performance on private debt to increase. Now, the reason why it's difficult to have a particular asset class or an investment strategy that provides universal protection is because private debt allocation of 5% is pretty typical. You're not going to find an investment strategy that's got, say, 50% in private debt. It's just not going to happen because of other issues such as liquidity, still wanting to have broad-based exposure. Another asset class that does perform well or can perform well in different types of inflationary environments that we don't have exposure to at the moment are areas such as commodities and gold. And commodities in particular are extremely volatile, and will have some, and in addition to gold, there's a very ESG unfriendly asset classes, because they can incur an incredibly high amount of carbon emissions in their extraction. So whilst we can present an investment case for why they might be useful, they might not be they might not be so well aligned with your sort of other objectives. And then in terms of the more problematic scenarios, such as the pandemic, stagflation, etc., there's no real asset class that's going to do well in those type of environments. It's going to put all asset classes under pressure. But where there's like a red box which is going to put pressure on equities, that's where we'd expect for the equity protection to really act as the shock absorber and give you that sort of the buffer and that additional protection. So there's more information on various asset classes here in terms of more in specific issues. But this is like the summary slide. And again, myself, Nick, and Josh, we did a lot of internal thinking about this, and we came to the conclusion that in like kind of 60% of the scenarios that we looked at, we did actually sort of think that the combination of the assets that you've got in terms of the mix of equities, traditional real assets, and also the direct inflation hedging should put you in a pretty good position to sort of weather most scenarios. Compared to where the strategy has been in the past, we certainly think the addition of private debt should be a useful diversifier. Because there's not going to be many other asset classes that would perform well in a sort of rising rate environment. A rising rate environment is expected to be pretty damaging for sort of nominal bonds and gilts. Fortunately, your portfolio does not have a very high exposure to those asset classes. So where that got us to in terms of conclusion was, as I mentioned before, in most circumstances, we think the fund should be able to weather various scenarios okay. For us, the one obvious question to consider maybe is if you wanted to increase the 40% inflation hedge to be something higher. Now, that is being considered with the FMRG in terms of some rebalancing work that we're looking at currently, but we wanted to sort of just flag that we're pretty much at the sort of maximum level of inflation hedging that we can do within the sort of the current risk management framework, and so if you wanted to go above that more materially, we perhaps need to sort of revisit some of the parameters that we've set that sort of govern the current construction of that framework. And the reason for that is because if you wanted to get more inflation protection through the use of the swaps, for example, we need to be sort of really cognizant that we've got enough collateral to sort of cover that. And so we're very comfortable with this level of collateral that you've got currently and the sensitivity around that. But the more exposure that you want, the more collateral you'll need to put in. If we needed to put more collateral in, we'd potentially need to make a disinvestment from elsewhere in the portfolio, and we wouldn't want to do that in a way that reduced your expected return. So there's multiple issues that we'd need to consider. So happy to take any questions.
Thank you very much, Steve, for the presentation on that. No one has. Shirley.
Thank you. Thanks, Steve. Just on the inflation protection, is there a reason, a risk also, that if we go further than we are at the moment and we haven't got a high level of interest rate protection, that will be out of balance, out of sync? Is that an issue for us?
Yeah, that is a balance. That is an issue, Shirley, and that's why we do have like the maximum constraints in now. What we're saying is that it's not impossible to increase the inflation protection more. It's just that we would need to depart away from the current framework, and we'd need to do more thinking to sort of put it together in such a way that we don't end up introducing risk elsewhere in the portfolio that we don't want. So we were not ruling it out, if you wanted to go down this direction, we're just saying we'd need to do more thought to sort of make sure it's got a proper framework around it.
Okay, thank you.
Not seeing anyone else at the moment. Nope. Thank you very much, Steve, for that. And just to clarify for my poor chairing from earlier, do we need to go into exempt session? Does anybody have any questions or issues they want to talk about with regard to paper 3? Appendix 3? No. In that case, can I have a mover to note the recommendations and to note that we have no issues that we need to take up to the full committee at this stage?
Happy to move note.
Thank you very much, Councillor Crossley. And a seconder?
Seconded.
Thank you very much, Pauline. Thank you very much. So now we move on to item 10 on the agenda, which is the risk management framework and a review for the period ending the 30th of September. And I believe Nathan is going to introduce this item.
Yeah, perfect. Thank you. So just a couple of points to note before we do move into exempt again. But yes, so on the performance of the RMF, LDI has been additive to returns over the period. No triggers breached. The equity protection strategy was additive to returns in September, but it has detracted since inception as markets have generally moved higher. So all of the RM strategies are performing as expected, and as Steve sort of alluded to, no immediate collateral concerns. The EPS is currently rated amber due to the sort of ongoing restructure to adjust for the change to the physical equity portfolio. So that exit from emerging markets, and FRMG have also discussed which counterparty of the existing 3 should take on the increased global exposure, and agreed that it should be the counterparty that's essentially losing the EM portion, as they scored highest in terms of sort of technical and operational expertise. So yes, we will need to move into exempt as Mercer have a paper here to cover in a bit more detail. Thanks.
Thank you very much. I assume no one's got any questions for the public session. So therefore, I will move that the panel has been satisfied that the public interest would be better served by not disclosing relevant information that we propose in accordance with the provisions of section 104A of the Local Government Act 1972, that the public should be excluded from the meeting for this item of business because of the likely disclosure of exempt information as defined in paragraph 3, part 1, schedule 12A of the Act as amended. May I have a mover for that, please? Thank you very much, John.
Happy to second.
And Councillor Crossley will second that. So goodbye to members of the public, and we will join you again shortly.